So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. This is 50 Pips rocking and rolling here, 20th of August, 2019. No trade calls, no recommendations, or response for their own stuff. We're here for educational purpose only. So, morning update. I'm doing it this way here with a video. It's just seems that some people are having problems with the audio player. I think because the actual player doesn't show up in the email that goes out, so people and are confused about where to go. But if you go on the website, it actually works. So we're trying to try and post it as a video as this is gets attached to the email. So what's going on today? Just a quick update. Well, I mean, in terms of data, we don't have that much going on. So as we discussed yesterday, it's really all about central banks, and it's really all about what Trump is going to say, tweet, or posture on, right? The big question, as I was discussing with subscribers, is this week going to end up being kind of like, we have the FOMC drift, where the market just slowly drifts higher into the FOMC, and then if we get a chance to sell, or at least as we've been seeing with Powell, it's after the FOMC. So the big question I raised starting on Sunday is basically, are we getting a Jackson Hole drift, right? Is the market just going to be in a slow grind higher mode, bar some kind of liquidity event going into Jackson Hole, and then we'll see? I mean, really, if you think about it, I mean, what is the real why would anybody with managing any size, anybody want to put on a big huge new position on here short ahead of Jackson Hole? We've seen what's happened in Jackson Hole in the past with Draghi, with the announcements of QE. There's just too much risk there, so it just doesn't make sense. I mean, you can try and leg into some positions or try and take some tactical bets, but really trying to get aggressive shorting a grind higher into Jackson Hole doesn't seem to be the most efficient use of capital, really. So there's nothing big that's changed since yesterday's update, but I'm going to try and make an effort just, in terms of paying it forwards to try and record more and more of these early morning updates, just to give you an idea of what my thinking is and what we're looking at. I mean, again, for the week, the interesting things are going to be tomorrow, the CPIs out of Canada. I think what could be interesting is basically the BOC surprising, or at least Polos and Co. having a reason to be a little bit more dovish or less hawkish as they have been. So I think USD CAD could surprise people to the upside. Ultimately, we do have those FOMC minute meetings too, which are going to be interesting. We'll probably talk about that in tomorrow's update. And then Thursday is very interesting because we got all those PPIs, a lot of EU data, and the PMIs out of the US too. But again, everybody's really going to be focused on Powell on Friday. Keep in mind that if memory serves, the speech, he's actually going to be speaking at 10 a.m. Eastern. But as far as I've heard, there's talk that the actual contents of the speech, or the actual transcript of the speech, may be released 60 minutes to 90 minutes ahead of time. So that basically means that from the open, right, on Friday, we'll have to be very, very aware. Here, I still think that, again, the focus is that things have calmed down following how Trump has backtracked on the tariffs on Huawei. We've seen Mnuchin, Kudlow, Navarro, everybody on deck trying to pump these things. So it's really all and only about the stock market. The other thing, which I think is interesting, the other development which we have to keep in mind, is basically the talk we've been getting out of the ECB, out of Olli Rehn, and what we've been hearing out of Germany too, right? Because if indeed we are going to get more stimulus out of Germany or out of the ECB, if the ECB ends up buying stocks a la Japan, right? Or if we do see more fiscal stimulus out of Germany, well, then you have to be very, very careful on some of those indice trades or some aggressive trades people have on right here, because we could just go full loco again. we still think that in this environment, it doesn't make sense to play for the big liquidity event and the big correction. We think it makes sense to stay tactically long equities, looking to be nimble and play for those 5 to 10% corrections, but usually we will get a very clear signal for those. So there are far better ways of spending the day than blindly shorting into strength, right? And you've seen with all these recent corrections we've seen, they've been multi-day events, and there's been plenty of time to get into them. So, people tend to make it harder than it should be, right? In terms of the dollar, again, we'll have to see what comes out of the on the wires out of Europe. I still think also there Euro has the possibility to surprise to the upside, even though I wouldn't necessarily be fighting flows. In terms of GPB, anything GPB is just headline risk, right? We still think things are going to get a lot worse before they get better, but we're one headline or one comment away from this being down 200 or up 300. I still think there'll be plenty of sellers until we get towards the back end of October into any rally, but you have to be a little bit cautious. We saw Aussie rally overnight. Again, it looks like Kiwi's trying to put in some kind of a base, but it's tricky because, especially with what we got out of the RBNZ, they seem to be the ones that will be, most happy or most willing to go into negative interest rates. So people are a little bit worried on that. And I think that still has a lot of negative pressure there. But, if we see markets going full crazy, ramping up, especially on China, Aussie and Kiwi should get a bit of a lift there, especially Aussie. So again, I think here on the currency side, and we've seen volatility is just, very subdued. It's just, they're just sleepwalking, right? Waiting to see what happens on the trade war, waiting to see what kind of headlines we get out of the central banks. So it really shouldn't be a surprise to anybody. And keep in mind that we're still in the summer chop. So remember, if you have to be active, usually in this kind of environment, it makes a lot more sense to widen out your stops, widen out your TPs, and drop your size considerably, rather than try and be aggressive playing tight plays, because just the liquidity isn't there. So all those tight plays with tight stops tend to just not work as well in this kind of environment. So again, it is what it is. As usual, we don't get to choose what hand we're dealt, but I think here it's even more important to focus on the wires, to focus on the headline risk, and keep the bigger picture in play, but just don't expect to be as active as you'd normally be, because it's still August trade. We're still waiting for a very, very big event, which is Jackson Hole, and again, things will free up from there very likely, and we'll have to see what happens into September. As now pretty much the market is pricing in rate cuts all the way through the back end of the year, and everything can be confirmed, changed, or muddied, made even less clear on Friday. So we'll just have to wait and see. Wishing everybody an awesome day ahead. Have a great one. Thanks for listening. Bye bye, guys.